Good morning. I'm Allison Carter. I am a tax associate director in our Lexington office, and I'm going to start out the tax update, and then I'm going to turn it over to my colleague, Maddie Schueler, who's a senior tax consultant in our Louisville office. And for the tax portion, we kind of wanted to switch gears away from all of the COVID legislation that we've had in the last year and kind of focus a little bit on, well, what's going on in the tax exempt world? What are we seeing? And what happened in the last year that we may have missed. And so first, I want to review some common foreign filings with alternative investments. We're increasingly seeing college and universities diversifying their investments into more alternative investments. And with that comes not only unrelated business income potentially, but also some foreign filings that we've noticed that some colleges have missed in the past, which could expose them to issues with statute of limitations on their tax returns, and then also some penalties. And then just look back at some UBI guidance. Last year in April, we received some proposed regulations on some of the guidance that came out of the Tax Cuts and Jobs Act, and it was a little overshadowed with all of the COVID legislation that came out last year. So just review some of the highlights in that, and then discuss just net operating losses really quickly. So some common foreign filings with your alternative investments. You could see some potential filings, and there are many more forms that I'm not going to cover here. This is just very high level of what we generally see. But in your materials, I did include a chart that has a little bit more foreign filings that you might see also. But the first one is Form 926, and it's where you transfer property or cash to a foreign corporation. And then Form 8865 is similar to 926, but it's when you transfer property to a foreign partnership. Form 8671, it's an information return of shareholder of a passive foreign investment company. And a passive foreign investment company, also called a PIFIC, is one where at least 75% of the income is from a passive source, such as interest, dividends, rent. And then a qualified electing fund, it goes along with the passive foreign investment company. And we're going to go into these in just a few minutes. And then Form 114 is the report of foreign bank accounts. And then the 8938 is statement of specific foreign financial assets. You may also see a WABN series, which is a certificate of foreign status. So if you're paying a foreigner any kind of money, you want to obtain this form before you pay, because there could be some withholding requirements. And then the 1042 series is kind of like the 1096 that you would file annually. So Form 926, this is a return of a U.S. transfer of property to a foreign corporation. It could be non-cash property, or it could be cash. And so you would use this form to report these transfers that are generally in excess of $100,000 or over a 12-month period, or where you own 10% of the company after the transfer. So most of the time with these investments, we would see the 100,000 threshold being hit rather than the 10%, because most of the time you're going to own 1-2% at the most of these type of entities. And the 100,000 is in the aggregate per entity. You'll see this a lot when you make the initial investment in the foreign corporation, and there can be severe penalties if you do not file this form. It's just an information return, so there's no tax due on it, but it's 10% of the fair market value of the property at the time of transfer, up to $100,000. There could be a more egregious penalty on any underpayment and from an undisclosed foreign financial asset, but we'll talk about that form in just a few minutes. But the one thing I want to make clear is that this is a direct or an indirect investment in a company. And so 8865, as I mentioned, is very similar to the 926, but this is for transfers of property to a foreign partnership. And so again, this could be indirect or direct. And the one thing with the foreign partnerships is that it's very hard to tell if you're directly invested in a foreign partnership. Most of the time it's indirectly. You might be invested in a domestic partnership, and then the footnotes will tell you that that entity is then invested in foreign assets. And so with a foreign partnership, some common ways to tell if it's foreign is an EIN that starts with a 9, or a foreign address. But I will tell you, we have seen foreign partnerships that have no indication that it's foreign. It might have a US address, a regular EIN, but then it really was a foreign partnership and there was no indication in the notes of it. So we'll talk a little bit later about what you can ask your investment advisors to warn you if you are invested in these type of entities. And then you would generally file the same, it's kind of the same threshold as Form 926 if you transfer $100,000 or more or own 10% after the contribution, and it's a $10,000 per failure to file. So that's per form that you were supposed to file. The 8671 is the information returned by a shareholder of a passive foreign investment company or a qualified electing fund. Most of the time you can get out of filing these forms. We generally see this, you could have a direct investment, but we generally see indirect investments through some of these other entities that you're invested in. Sometimes those entities will file this on your behalf and there'll be a footnote in the K1, but then it's not always easy to tell that way. So some other exceptions, if this K1 is not unrelated business income to you, then you would have an exception to filing the 8671. If the activity that you're investing in is not debt financed, if you did not take out any debt to finance this investment, then then you wouldn't have to file the 8671. And then I just wanted to mention the foreign corporations. A lot of times you are invested in these foreign corporations because they're what's called a corporate blocker. They block from unrelated business income. So while you may not have any UBI being triggered with these activities, you would have some foreign forms. There's no specific penalty provided on the 8671, but there could be a subject to the $10,000 failure to file penalty with the 8938, which we'll talk about in a second. The other issue with this is not only is the penalty, but if you fail to file this, then you don't have an exception that's met, but you could also result in an incomplete tax return because Schedule F of your Form 990 requires these forms to be attached. So one, the IRS could say your form is incomplete and they could subject you to the daily penalties for the 990 not being filed on time. But then also it leaves you open, your statute of limitations open. Form 114 is the report of foreign bank accounts. It's used to report any financial interest or signature of authority over a foreign bank account. Again, this could be direct or indirect. If you have an activity, let's say you have, it could be with your investments, but then let's say you have someone doing a travel abroad program and they have to have a bank account over there. If the university has any kind of signature authority, they need to file this form. And it's for $10,000. If your bank account hit $10,000 at any time during the year, and that's in the aggregate, you would need to file. There is a $10,000 failure to file penalty, and if the IRS says that you willfully neglected to file, they could have a lot harsher penalty for this. The form is due on April 15th, so it's not due with your tax return, and they give an automatic extension until October 15th. The one thing I forgot to mention on the 114 is that as an officer or a director or trustee of the organization, if you have signature of authority, you would also have to file one with your personal tax returns. And it would just mirror the information that the university would have to file. And then Form 8938 is Statement of Foreign Financial Assets. So currently, it's not applicable to tax-exempt entities. There has been some discussion about maybe that this could be applicable, and it also has generally a $10,000 failure to file penalty. The W-8BEN series, so this is a certificate of foreign status. It's similar to a W-9 for a U.S. person, so best practice is to always get the W-4, the W-9s, and the W-8 for any foreign individuals. You would generally get this before making the payment, and there is a 30% withholding required on all of these payments. Some of the forms, the W-8s will need an identification number from the foreign individual, which also can be an issue. So if you run across that, you probably want to reach out to your tax advisor to help navigate through that. The foreign person could provide, there could be an income tax treaty. So when you get the W-9, you don't have to audit the form, but you do want to do some due diligence to maybe take a look at the treaty if they're listing one, because they might not understand what type of income that they're actually receiving and just make sure that that they actually do have an exception to for this. And then there are specific rules and deadlines regarding the tax deposit of this, so you want to make sure that you're in compliance with that. The 1042 series is the annual withholding. As I mentioned, it's like Form 1096 that you would file with your 1099s. And so this is where you would report the withholding on the payments if there wasn't an exception provided. The late filing is 5% per month, up to 25%. So what questions should you ask your investment advisor? So one would be, are any of my alternative investments a partnership or an S corporation in which income would be provided to me on a K-1? S corp income is always unrelated business income. Doesn't matter the nature of the activity, it's always UBI. A partnership, not necessarily. It could have unrelated business income, it might not, but then also it could have some foreign filings. And then are all footnotes complete, and in any PIFIX, Form 8865, 926s, are they listed completely with all the information that you need? We have seen before, and you can reach out to your tax advisor to help with this, we have seen before where they're not complete, and we'll just go back to the investment advisor and ask them to get in touch with the entity and try to get this information. Am I invested directly or indirectly? The key here is to make sure they understand that you don't want just direct investments. You want to know if indirectly you're invested in any foreign corporation or any partnerships. And then did I transfer any cash or property to a foreign corporation or a partnership during the tax year? And that's what's going to help us determine whether any of these filings are going to be required this year. And so if you have any questions with this or need to explain to the investment advisor, your tax advisor would be happy to help with that and walk them through that. We've had to do that with clients before to kind of help understand what type of information we really need to know. So any questions about the foreign filings? Okay, I'm going to go quickly through this. So we know back in 2017 we received the Tax Cuts and Jobs Act. It requires organizations to calculate the UBI separately for each trade or business. In 2018, we were provided with just interim temporary guidance. And then in April of 2020, we received proposed regulations. So while these are not final regulations, it gives us an idea of where the IRS and Treasury is going with the final regulations. And so with the Tax Cuts and Jobs Act, just to go back on this real quickly, separately compute UBI. They did change net operating losses where you have to separately calculate those for each activity. And then they repealed the fringe benefits parking tax. So if you did pay any and report that on your 990T and haven't asked for a refund of that tax, please make sure to do that as soon as possible. You want to make sure before your statute of limitations runs out. So Notice 2018 gave us concepts for identifying separate trades or businesses, and then interim guidance for purposes of the new 512A6. Principles surrounding partnerships, interim and transition rules for aggregating income from these partnerships, and then information on calculating net operating losses. So the big thing that came out of Notice 2018 is that to group activities, you are allowed to use the 6-digit codes from the North American Industry Classification System. Well, there are over 1,000 6-digit codes. So that didn't leave a lot of room for you to group these activities. And the importance with grouping these activities is that if you had losses from one activity and income from another, you could offset those activities, whereas you couldn't if they were not grouped. And so the proposed regulations allow us to use 2-digit codes. So there's only about 22-digit codes. So that allows for a lot more grouping of your activities. And we've already seen over the last year that has been beneficial to tax-exempt organizations. The proposed regulations do disallow an exempt organization from using the 2-digit code that describes their exempt purpose. So a university wouldn't be able to use the education code for all of its unrelated activities. The proposed regulations allow the aggregation of UBI investments. I think we're running out of time, so I'm not going to go through that, but there's 2 tests that allow you, and most of the time if you're invested in these alternative investments, they will, you'll be under that 2% threshold and be able to group these activities. So we'll go through that. The one thing on controlled entities, if you have a controlled entity, 2 controlled entities that you're receiving rent from and it's unrelated business income, you can't aggregate those two and group them on the 990T. They would have to be separate activities. The proposed regulations allow organizations to disregard debt financing. So if you have passive income, such as interest and dividends you earned, that's subject to UBI because of debt finance, you can group those activities. If the activity was unrelated business income without it being debt financed, then those would have to be separately computed. And then just wanted to mention on the net operating loss, the CARES Act allowed for a 5-year carryback of your NOL. So if you starting in 18 through 20, if you have any net operating losses, you are allowed to, which those are your siloed losses, you're allowed to carry those back 5 years and get some of the tax paid in previous years without siloing these activities. So they could offset any activity. We have one question. Where can we find the treaty of reference on the W-8BEN? So the IRS has all of those treaties on their website, but if you have any questions about that, we can definitely pull a specific treaty for you. I think that's it. Does anyone have any questions? If not, I'll turn it over to Maddie. Okay.
All right, thank you, Allison. I am going to switch gears a little bit. My name is Maddie Schueler, and talk a little bit about the outlook for federal taxes and what we might expect in the coming months. So a lot of you may have heard that President Biden has issued some tax plans and talked about some tax proposals on the campaign trail. And so we're going to talk about what, kind of at a high level, what's in some of those. So I'm an attorney, so I have to have my disclaimer up here, but just as an FYI, this presentation is focusing on the proposals that Biden had during his campaign and that were released in recent weeks. But we don't know what form those proposals will take if and when they're enacted. So as we all know, all laws have to be passed by Congress and then signed by the president. And there's likely to be a lot of negotiation over a lot of these proposals. And so the ultimate form that they might take, when they might be enacted or when they might be effective, those are all just unknowns right now. But we thought it might be interesting to walk through some of what we might see in the coming months. So today I'm going to talk a little bit about the Made in America tax plan, which is President Biden's tax plan that's focused on corporations and businesses. And then we'll talk about the American Families Plan, which is more individual focused. And then just for a couple minutes, I'll talk about some other tax proposals that didn't make it into either one of these plans, but that were talked about on the campaign trail. So just a quick timeline here. Of course, we know in January, President Biden assumed office. And then at the end of March, the White House released the Made in America tax plan. That was a complement to the American Jobs Plan that I'll talk about just a little bit. And then at the end of April, the White House released the American Families Plan, which again was focused more on those individual tax provisions. So the Made in America tax plan, that would be used to pay for his American Jobs Plan, which is focused on infrastructure. So think about roads, bridges, internet access. It's focused on all of that. And of course, there's got to be a way to pay for all of those infrastructure improvements. So the goals of the tax plan as released by the White House are to incentivize job creation and investment in the US and to stop unfair and wasteful profit shifting to tax havens. And then finally, to ensure that large corporations are paying their fair share. So you'll see a lot of this sort of commentary about wanting to make sure that corporations are paying their fair share in taxes, to make sure there aren't incentives for corporations to set up operations overseas, to move some of their profits overseas in order to try to avoid taxes here in the US. What's in the Made in America tax plan? It would increase the income tax rate on C corporations from a flat 21% to 28%. So before the Tax Cuts and Jobs Act, which was passed during the Trump administration, the top rate was 35%. And then the TCJA dropped that down to 21%. So it was a pretty dramatic drop there. President Biden has proposed increasing it to 28%. So not quite all the way up to its pre-TCJA level, but again, a pretty substantial increase from where it is right now. He's also proposed a 15% minimum book tax on corporations that report net income of $2 billion or more, but don't pay any federal income taxes. So there's this focus on this minimum tax. We don't know exactly what form that would take, but that corporations, again, that are finding ways to shift their profits to avoid federal income taxes, even though they're reporting book income. And then targeting U.S. businesses that are offshoring profits. He's got some incentives for clean energy production in there, and then ramping up enforcement to address corporate tax avoidance. So this focus on making sure that resources are provided to the IRS so that they can enforce the tax laws and go after these corporations that are trying to avoid paying their fair share in taxes. So that's the Made in America tax plan at a very high level again. And now I'll shift gears a little bit to talk about the American Families Plan, which I think might be a little bit more of interest to some of you, talking a little bit more about some of the individual tax provisions that we might see. The American Families Plan, as released by the White House in their fact sheet, it has several goals. So one of those goals is to add at least 4 years of free education. That would be 2 years of free universal preschool for 3 and 4-year-olds, and then 2 years of free community college. Another goal is to make childcare more affordable, make sure that we're investing in that childcare workforce, creating a national paid family and medical leave program, and then cutting taxes for workers and families. So tax cuts for lower to middle income Americans while raising taxes on the wealthy. So of course, those are a lot of big goals, and there's got to be a way to pay for a lot of those programs, which is where the tax side of the American Families Plan comes into play. Again, you're going to see an increase, or perhaps going to see if this comes to pass, in the tax rates. So the plan proposes increasing that top individual income tax rate from 37%, which is where it is right now, up to 39.6%. For those in the top 1%. Of course, that's not defined right now. Still light on details with a lot of these proposals, and it just broadly refers to the top 1%, but you can see that focus on the higher income Americans and raising their tax rates. That top rate of 39.6% would also apply to investment returns, so capital gains, qualified dividends that right now are taxed at a preferential rate at a top rate of 20%. For households that make more than $1 million, that rate would go all the way up to 39.6%. So that would be a really big increase in the rate for capital gains. If you added in the current 3.8% net investment income tax, you've got over a 40% top rate for some of those capital gains for the higher income households. Low to middle income taxpayers. So although we talked a lot about raising taxes on the wealthy, there are also some tax savings perhaps for lower to middle income taxpayers. The American Rescue Plan, which was passed in mid-March, it was another piece of stimulus legislation during the pandemic. It contained some enhancements to tax credits. So the child tax credit, the earned income tax credit, and then the child independent care tax credit. Those were all temporarily enhanced. Some of them were made refundable. The amounts of those credits increased in an effort to help working families during the pandemic. And so as part of this American Families Plan, a lot of those enhancements to these tax credits would be made permanent, again, to help lower to middle income taxpayers. One interesting proposal is this pretty much virtual elimination of like-kind exchanges. So a like-kind exchange is where a taxpayer has a piece of property, of real property, that they use in their business or they use for investment, and they can exchange that for another piece of property of like kind, which is referred to as the replacement property. And when they do that, when they engage in this like-kind exchange, they can defer recognizing the gain on the property they exchanged until that replacement property is sold. So this is a common tax incentive that's used a lot in the real estate industry, for instance. And under the American Families Plan, it would eliminate like-kind exchanges for gains of more than $500,000. So I've seen some commentary that this pretty much would result in kind of virtually eliminating this tax benefit because of all the hoops you have to jump through to do a like-kind exchange, all the boxes you have to check, that there are certain taxpayers who wouldn't feel it was worthwhile if it only applies to gains of up to $500,000. So that will be something interesting to watch to see if that makes it into any final legislative package. Elimination of stepped-up basis at death. This, I think, is a really impactful change. If it were to come to pass, it would be a major change from the way our tax law is written right now. So right now, if you inherit a piece of property when someone dies, your basis in that property is the property's fair market value. And what that means is then if you turn around and sell that property right away, you're probably going to sell it at fair market value or close to fair market value. And so you wouldn't have any gain when you sell that property because you've got a basis of fair market value, and then the proceeds that you're receiving would be the fair market value of that property. President Biden has proposed eliminating stepped-up basis for gains of more than $1 million. He's mentioned protections for donations to charity, for family-run businesses, and then for farms. So we don't know exactly how those would look or how they would apply, but that there would be some protections in there for some of these instances. So again, I think this is a proposal that we really don't know exactly how it's going to look, but it would change a major bedrock of our current tax law. It would result, I think, in a lot more estate planning for high wealth individuals on how they would deal with this if it comes to pass. And then just quickly, because I know we're a little bit short on time, but these are some other proposals that were mentioned on the campaign trail, but weren't part of the American Made in America tax plan or the American Families Plan, but could perhaps be part of any final legislative package. So some other things that President Biden mentioned on the campaign trail were limiting itemized deductions for taxpayers who make more than $400,000. That would include what's called the QBI, or Qualified Business Income Deduction, which is the deduction for owners of pass-through entities. So again, you see this theme of raising taxes on higher income Americans. He did mention several times that taxpayers making $400,000 or less would not see their taxes increase under any of his proposals. And then a $15,000 tax credit for first-time home buyers was something else that he mentioned, but again, I have not seen that mentioned in any of the tax plans that were released by the White House. Some estate tax proposals were also mentioned on the campaign trail, raising the estate tax rate from 40 to 45%, and then dropping the exclusion amount. So the gift and estate tax exclusion is a certain amount that you can gift away during your lifetime or at death without paying gift and estate taxes. So you can see here for 2021, it's 11.7 million, so it's a pretty high threshold. That is actually going to drop automatically in 2026 to an inflation-adjusted $5 million. It's already set to revert back if nothing were to change. But Biden mentioned on the campaign trail dropping that even further to $3.5 million, and he would perhaps do that sooner than 2026. So again, I did not see this mentioned in the American Families Plan, but is something that that has been out there and potentially subject to negotiation could happen. And then other federal taxes, Biden mentioned extending the Social Security tax to earnings above $400,000, and then a financial transaction tax. We don't know exactly how that would look. Maybe that would apply to purchases and sales of securities, but just some other things that he mentioned along the campaign trail that we may or may not see. So I see I've got one question. And this might be more towards you, Allison, but are there Kentucky reporting requirements for payments to foreign vendors? I don't, payments to foreign vendors, yeah. Yeah, she mentioned she's not aware. I'm not either, but certainly something we could follow up on. But yeah, nothing that comes to my mind of any requirements there. I don't see any other questions, so I'll kind of open it up for anybody in the audience if you have any questions for us. I don't want to stand between you and lunch, so yeah. Yeah. Oh, I gotcha. She mentioned that increase to the corporate tax rate, which has been proposed to 28% under Biden's proposals, would impact the 990T. So something to keep in mind there. All right. Thank you guys very much.